everybody. We are down to the last bit of the accounting cycle. You almost know the entire accounting cycle, so that's pretty awesome. So the last part is closing the accounts. If you are in Monday, Wednesday, Friday classes, this is class number 14. If you are in Tuesday, Thursday classes, this is class 10B. So you should already have watched video A for class 10 if you're a Tuesday, Thursday person. Then this is the second video for class 10. And we're talking about closing accounts now. So if it's a cycle, right, the accounting cycle, obviously kind of goes in a circle. We start over again, right? So in order to start over again, we want to start over with a clean slate for some of our accounts, right? So not all. We don't close all of them, just some of them. So if we're going to have it be a cycle, we obviously have to kind of go around this cycle and start over again. So that's what closing is about. It lets us start the cycle over again with a clean slate. So let's learn about closing the accounts. All right, so what is the closing process and how do we close the accounts? In order to measure each period's net income separately from the income of all other periods, revenues and expenses are closed. The closing process is a step in the accounting cycle that occurs at the end of the period. The closing process consists of journalizing and posting the closing entries to set the balances of the revenues, expenses, income summary, and dividends accounts to zero for the next period. So we have a new account here, income summary. That's an important part of closing, so we'll get to that in a minute. So the accounts you close out and zero out are your revenues, your expenses, the special new income summary account, and dividends. Zero them out, that way they start accumulating again for the next period. A temporary account, so the slide lists temporary accounts. A temporary account is an account that relates to a particular accounting period and is closed at the end of that period. So remember, we're accounting for a period of time, and if it applies only to that period, we close it. The revenues, expenses, income summary, and dividend accounts are the temporary accounts. By contrast, a permanent account is an account that is not closed at the end of the period. The asset, liability, common stock, and retained earning accounts don't get closed. So how I think about it is the balance sheet accounts carry a balance from period to period, so they stay open because they're going to have a balance that carries over. Net income accounts don't carry balances over. So the temporary accounts are the revenues, the expenses, and the dividends and the income summary. But the other balance sheet accounts, they carry a balance over. All right. So let's talk about closing entries, right? So we're going to close an account that has a balance in it, like supplies expense, right? It's got a balance. We spent some money on supplies. If we're going to close it out, we obviously have to do some transaction to get that balance out of there. Closing entries are entries that transfer revenues, expenses, and dividend balances to the retained earnings account to prepare the company's books for the next period. This transfer to retained earnings also causes the retained earnings ledger account to now equal its balance as reported on the balance sheet. As an intermediate step, the revenues and the expenses may be transferred first to an account titled Income Summary, I-N-C-O-M-E, Summary, S-U-M-M-A-R-Y. The Income Summary is a temporary account, so obviously it's one of those accounts that gets closed. Temporary accounts get closed. The Income Summary is a temporary account into which revenues and expenses are transferred prior to their final transfer into the retained earnings account. This account summarizes net income or net loss for the period. So let's look at the next slide and we'll kind of talk about how we close it. So we close accounts to this special other kind of account. All right, so closing entries transfer the revenues, expenses, and dividend balances to the retained earnings account to prepare the company's books for the next period. The income summary is a temporary account to which revenues and expenses are transferred prior to their final transfer into the retained earnings account. It summarizes net income or loss for the period. Closing the revenue accounts requires that a debit be entered into the revenue account in an amount equal to the existing balance. So think about this. All through the month, we've been crediting revenue, right? Every time we earned some revenue, we credited the revenue account. So it's got a credit balance, right? So it's kind of, if you look here, you'll see how we've been crediting it all along. So you'd have a credit balance normally in revenues. Well, to zero that out, you have to have a debit, right? So you debit whatever the balance is, you debit the revenue, right? So that's easy. So if you have a $500 credit in revenues, you just put a $500 debit in revenues, and now the balance is zero. Easy peasy. But we know every time you have a debit, you have to have a credit. So what do we credit? Well, that's what this new income summary account is for. This income summary account, is where we're going to do our credit. So that way it's a place to hold it temporarily. All right. So closing the revenue account requires that a debit be entered into the revenue account in an amount equal to the existing balance. The matching credit is entered into the income summary account. Next, each expense account receives a credit entry in an amount equal to the debit balance in each expense account. So expense accounts, and you'll have more than one of those, right? You'll have wage expense, supplies expense, rent expense, depreciation expense. You'll have all these different accounts with expenses. So each one of those, whatever its balance is, and they're expenses, so they have a debit balance. So whatever that debit balance is for that expense, you post a credit in that same exact amount. So it zeroes out that expense, and then you post your credit to income summary. So now income summary has the revenue balance, the expense balance posted to it, and the debits and credits won't equal in income summary because presumably you had a net income or a net loss. So the difference between them in that account, that's your net income. All right, so after this transfer to income summary, all of the revenue accounts and expense accounts will show a zero balance. The income summary account, when balanced, will have a balance equal to net income or net loss. The income summary account is then closed to the retained earnings account, right? So what happens is we close our revenues to income summary, we close our expenses to income summary, whatever the difference is between these two, right? So presumably the revenues will be more than the expenses, so you'll have a balance that you need to make up for. That's the difference, which is the net income. So you're going to probably debit that amount because it's probably a net income, and then you'll credit retained earnings, right? This is how we get net income into retained earnings. All right. So when you do that, when you put the amount of the income in income summary, and put it in retained earnings, now you've zeroed out this, right? So all your revenues, your expenses, and your income summary are now zero. You've moved that net income into retained earnings. Then the last thing you do, the dividends account has a debit balance and is closed with a credit entry equal to the balance in the accounts. The matching debit is entered to retained earnings. So for dividends, whatever dividends you've paid out, let's say you've paid out $5,000 dividends over the course of the year. That would mean it has a debit balance of $5,000, right? Because dividends are always debits, except for when we close, right? So when we close, what we're going to do is post that, whatever that balance is, in the credit side, and then we debit retained earnings. So now dividends is zeroed out. All right? So the steps for closing the accounts, pretty simple. Close revenue to income summary. Close expenses to income summary. Close income summary to retained earnings. Close dividends to retained earnings. There you go. You've closed all the accounts you need to close. Don't close any others. So, let's look at an example. Smart Touch Learning. In the case of Smart Touch Learning, the service revenue account showed a credit balance of $17,500. A closing entry is prepared to debit service revenue for $17,500 and a credit to income summary for $17,500. So we're closing the account. So of course, like any other transaction, we journalize it, then we post it. So service revenue is a debit because we're closing it, right? Normally revenues are credits, I know, but just this one time, whenever you close it, you post a debit. And then your credit goes to income summary. Then you just post it, right? Your debit and your credit to your T account. Then we're preparing the closing entry. So this is how you journalize closing the expenses. Remember how I said you have to close each one separately, all right? You can't just write expenses and the amount and then income summary and the amount because you have to close the accounts. So we prepare a closing entry by crediting each expense account and making a debit entry to income summary for the balance. So of course expenses, as we're accruing them, we're always putting them down as debits. So to zero them out, you credit that expense. And the debit is income summary. Then you credit each expense and you've closed out the expenses. All right, now we're done with income summary. It's a temporary account that we only use to total up the income. So when you look at income summary, right? You've got credits, debits. Your credits are larger than your debits, so you've got a balance of $88.50. Well, that's the net income. Your revenues minus your expenses, that's net income. So you have a debit balance, which is net income. So to close that balance out, you credit it. Or you debit it, sorry. You debit it, right? That's your net income. So you debit net income and you credit retained earnings. So basically what we've done is closed out the revenue and the expense accounts to income summary. Now we close income summary to retained earnings. And that net income amount now has moved into retained earnings. Remember we've talked about how retained earnings are where the income contributes to the owners and whatever they don't pay out in dividends stays in the retained earnings account. This is how it gets there. We close the revenues and expenses to retained earnings, to income summary, and then we close income summary to retained earnings. So that's how that got in there. So your first step, close revenues to income summary. Second step, close expenses to income summary. Third step, close income summary to retained earnings. Final step, closing the dividend account. So maybe not, but maybe over the course of the period, the company has paid out some dividends to their stockholders and they've been accumulating that in the dividend account, and the dividend account has a debit balance. So that has to be closed to retained earnings. Because think about it. Think about when we do the retained earnings statement, we take beginning retained earnings plus net income minus dividend equals new retained earnings. This is how we get that. So we close the dividend account to retained earnings. So dividends are carrying a debit balance, they need to be credited. So your debit is to retained earnings and your credit is to dividends. All right, so if you were to look at the journal entries for the closing entry. So we've done them all. So here's just that journal page with all the entries all in one spot. So we have, if I asked you to do the closing journal entries, this is what it would look like. You close revenue to income summary, expenses to income summary to retained earnings, and close dividends to retained earnings. So that's all of the journal entries all together on one page. All right, if the business had a net loss, oh, I'm sorry, go back a page. If the business had a net loss, it's still the same thing. You're still closing the accounts, right? You're still closing revenue to income summary and expenses to income summary to retained earnings, and dividends to retained earnings. You're still doing those 4 steps, but the difference is in income summary, right? If you have a net loss, the debit side is bigger than the credit side when you balance out the revenues and expenses, so you have to credit that loss instead of debit it, right? And then that means you debit retained earnings and credit income summary. So that's the difference. You just flip that entry where you're closing income summary to retained earnings because, well, it's on the other side. Finally, and we really are almost done. It's the end of the month, it's late. It's the last day of the month, it's late in the day. And all month long you've been tracking your transactions and you've been analyzing, journalizing, and posting every single transaction that happened. You did an unadjusted trial balance, you balanced your debits and credits, yay. You sat down and you thought about, well, what else happened? You did some adjusting entries. You did an adjusted trial balance, your debits and credits balanced, all right. So you sat down and you prepared the financial statements. Income statement first, statement of retained earnings second, balance sheet third. Then you went back and you closed the accounts. I'm done. My financial statements are good. Everything's great. I've zeroed out my temporary accounts, right? I zeroed them out by closing revenues to income summary, expenses to income summary to retained earnings, dividend to retained earnings. I've closed the accounts. I'm done. Wait. Better make sure we did those debits and credits right when we close the accounts. So we do a post-closing trial balance. After closing entries are recorded and posted, the accounting cycle ends with a post-closing trial balance. The post-closing trial balance is a list of the accounts and their balances at the end of the period after journalizing and posting the closing entries. It should include only permanent accounts. So remember, the temporary accounts are the ones we closed. Revenues, expenses, income summary, dividends. The permanent accounts are the things that are going on the balance sheet. So you write down, just like all our other trial balances, at the top you put the company name. What is this? Post-closing trial balance and the date, so last day of the month, last day of the year. And then you're going to have really just your assets, liabilities, and owner's equity accounts that are not dividends, right? So there you go. That's what it is. At this point, since all the revenue, expense, and dividends accounts have been closed, they will have a zero balance. The resulting post-closing trial balance lists only permanent accounts and shows the debits are equal to the credits. Let's make sure we understand what is the accounting cycle. All right, so now we've gone through each little step. But it took us 4 chapters. We did it a little at a time. So I want to take a minute here to make sure you understand the whole cycle. All right? The accounting cycle is the process by which companies produce their financial statements for a specific period. It is the steps that are followed throughout the time period. The accounting cycle starts with the beginning asset, liability, and stockholder equity account periods left over from the preceding period. So a new period actually starts with the old post-closing trial balance. You just have your balance sheet that's got those accounts. Alright, so that's all the accounting cycle is. Alright, is analyze and journalize and post your transactions as they occur during the period. Then, at the end of the period, do an unadjusted trial balance, do adjusting entries, do an adjusted trial balance, prepare those financial statements, close the temporary accounts, do a post-closing trial balance. So that's really the accounting cycle. Easy peasy, you can do it. Alright, what's the business ratio we can learn about this time? Well, let's learn about the current ratio. Alright, now you may recall we've learned about a classified balance sheet. So the current ratio makes sense because we've started dividing assets and liabilities into current, right, and long term, stuff like that. So the current ratio measures a company's ability to pay its current liabilities with its current assets. A company prefers to have a high current ratio because that means it has plenty of current assets to pay its current liabilities. A strong current ratio is 1.5, which indicates that the business has $1.50 in current assets for every $1 in current liabilities. Current ratio of 1 is considered low. So let's think about that. Right, my current assets divided by my current liabilities. So your current assets are those ones from that current category in the classified balance sheet, and current liabilities from that current category on the liability side. And it makes sense. You want to be able to cover your liabilities with the most current assets, because otherwise what you're going to do, it's not like you're going to sell your building to pay off your current liabilities. So that's the point of that. And you did it. You've learned the accounting cycle. Now really, most of the rest of this class is kind of like drilling down on parts of the cycle, right? Like we might learn how to do an income statement for a company that has inventory. Oh, now we got inventory. Let's learn about inventory, right? So we're going to just keep drilling down, but it all fits within this cycle. So the point is to get the right information on those financial statements. So it's all going to come back to this preparing of the financial statements in the end. All right, well, good luck with the exam, because that'll be coming up next for you. Now that we've finished Chapter 4, we'll have an exam, and we'll go over that soon. All right, bye.